Yeah, so plenty of companies reporting results today. We'll be taking you through those in more detail coming up. Now let's just turn to what we've been seeing in the bond markets and get some more detail from Michell from FIIG Securities. Simon, good to see you there. Now, we saw US Treasury yields pulling back around that 2.7% mark at the end of last week. Just some questioning there about the data and whether the US data that we've been seeing is weak because of the weather or because of weakness in the US economy. I mean, what's your view on how the bond markets fared last week?
Yeah, morning, Bridie. We have been seeing a continued theme of weaker data coming out of the US recently. Obviously, a bit of a focus on the tapering program. The message there has been fairly consistent. They're pretty happy with the expectation there, but the data is still coming up on the weaker side, and that's going to start having investors question the tapering program, whether that needs to be eased back a little bit, whether they want to stick to the current program. Interestingly, we actually had a strong finish domestically. Our 10-year Commonwealth Government bond rate was actually up to 4.22. It has been as low as 4% this month, so that's almost up 0.25%.
Yeah, and just in terms of Australian bonds, I mean, there's a story in the Wall Street Journal Asian edition this morning about Japanese investors now returning back to the Australian bond market, snapping up high-yielding bonds there again. I think about $3.6 billion of Australian bonds bought in the 3 months to the end of December. Is that a theme that you're thinking will continue then?
Look, definitely. I mean, we've seen constant demand for the strength of the local domestic economy and our yields very, very high. That's been the issue with keeping that dollar so strong, the demand for our currency. We don't see that diminishing anytime soon because the margins are still very attractive on a global basis, very good yields for investors, and also the credit quality of our market, given that we're still one of the only governments with a AAA rating. That's also seeing continued demand for Commonwealth Government bonds. We don't see that abating anytime soon while our interest rates are at these levels.
And the idea being too that you think the RBA is now at least on hold.
That's right. So they've moved from an easing bias to a neutral bias. That says they don't really see any case for lower rates moving forward. Obviously, what came out of the G20 finance ministers meeting over the weekend about this focus on growth, that's positive for the RBA, for our domestic economy, because it's been that soft growth in employment, in wages growth, that's really been a concern to the RBA and could have seen them move back to an easing bias. With a focus on that growth, I think that they'll be happy with that outcome, and they'll now be trying to manage the transition from a high cap expenditure resources scenario to more consumer demand and growth in that retail sector coming through.
And just on the G20, that growth target, I mean, it's a soft target and also it's really aspirational as well. We've already had the German finance minister sort of, questioning it, if you like. I mean, is it that market moving, do you think? I know you said at least it's a positive.
It's a positive. I think it's definitely a positive focus. I mean, obviously we want to see what they come up with in November at the G20 meeting in Brisbane, where they'll present those policies and we'll get a bit of a closer look. I think it's good to have a focus on that. They need to focus on growth to get the debt levels down. I think if they can come up with some good policies that the market likes in trying to stimulate growth, the market's going to see that as a positive. But as you say, we'll look for the details in November.
Okay. What else should investors be watching out for this week? I know we have a host of companies reporting, like Qantas, of course, a lot of focus on whether it gets that debt guarantee from the federal government.
That's exactly right. A lot happening in announcements, so we'll be focused on that. That's going to be much more of an issue in relation to what we see in the domestic economy as opposed to what we see on yields, because we're not going to see a lot of information coming out in yields essentially at the moment.
Look, we will let you get that phone call. Sounds important. Very busy day ahead, I bet. Thank you so much for that.
Thanks, Bridie.
Michell there from FIIG Securities.